All right, ready when you are.
All right, thank you. I would like to call the Investment Committee meeting to order and ask Board Secretary Mark Foley to call the roll, please.
Thank you, Vice Chair Gromberg. Trustee Malone,
Here.
Trustee Roy,
Here.
Gray, Trustee Gray,
Here.
Trustee Hall. All right, great. Vice Chair Gromberg, you have a quorum.
Great, thank you. Lynn Cole, would you please introduce any members of the media that are listening in?
Thank you, Chair Gromberg. We did not receive any RSVPs, but we're pleased to welcome any members of the media who might be viewing the live stream.
Okay, great. Thanks, Lynn. The committee meeting agenda was provided in advance of this meeting. Are there any objections to adopting the agenda as presented? Hearing none, the agenda is adopted as presented. You are previously provided with a copy of the minutes from the June 5th, 2025 committee meeting. Are there any objections to approving the minutes as distributed? Okay, hearing none, the minutes are approved. So now we'll go to Nolan Bean with Fund Evaluation Group. We'll now discuss recommendations for the Pooled Endowment Fund and the Liquidity and Capital Reserve Pools. Nolan, over to you.
Thank you. Good afternoon, everyone. Appreciate everyone hopping on. We are gathered because a couple of the investments that we are going to be discussing had a quicker timeline such that we couldn't cover this business at the next regularly scheduled Board of Trustees meeting. So while we are together, I'll give you a quick update on the markets. I know you all follow them closely, but we'll share our thoughts as it relates to the portfolio, give you an update on performance, how the portfolios are positioned, and then cover the recommendations. The last thing I'll say at the outset, there are several recommendations and commitments. I just want to level set that these have come in bunches. If you look at the size of the portfolio today on the Pooled Endowment Fund at over $2.6 billion, roughly 30% of that is invested in privates. To hit our targets, our best estimate is we should commit roughly $180 million on an annual basis. We'll never hit that perfectly. We've committed $60 million so far calendar year to date, and the recommendations we'll discuss are $68 million. So it'll get us to roughly $130 million. So still below that target. We are trying to be disciplined and conservative because we haven't seen a lot of liquidity, but it does look like a lot. So I thought that background would be helpful before we dive in. So if we want to jump into the slides, thank you. So here's the agenda: market performance update, recommendations, and then a little bit of forward-looking next steps. So it has been an interesting market. One of the things that I get to do is come up with a theme each quarter. Our theme for the market in the second quarter was fireworks. There was a lot of activity. Despite everything that happened around the world and in markets, what we're showing here is the markets powered forward and ended the quarter on a positive note. Pretty much any asset class you want to look at here. So different flavors of public equities, fixed income, real assets, hedge funds, you name it. So it was a good quarter on an absolute basis, despite a little bit of a wild ride. Next slide. One of the big events was the one big beautiful bill. I won't go into all the gory details. We just hit a couple of the highlights. I would say the headline was equity markets generally viewed this as pro-growth, which is a good thing. So that was one of the things that among many that led to strong results on the quarter. On the next slide, this one didn't get a lot of headlines, but we did have during the quarter Moody's downgrade the U.S. Treasury from its AAA rating. S&P's already done this. Markets have largely shrugged this off. I think this is a problem for another day, but it is something that we pay attention to. What we're showing here, just to put it in context, is the United States Treasury now spends more on interest expense than we do in national defense. So at some point, we do need to get our fiscal house in order. One of the many things to worry about in the world. But again, just kind of highlighting, there was a lot of activity for the quarter. If we can go one slide ahead. One of the other themes, I flew by that performance slide, but non-U.S. equities have performed quite a bit better than U.S. equities. And we do have, call it around a third of our public equities invested in non-U.S. equities. and the dollar declining helped tremendously. So the U.S. has been the place to be. If you look at all of our all of our asset classes, the vast preponderance of all of our money is invested within the U.S. Having some level of international diversification in public equities, you get the return of not only the stock market in the UK or in Japan, but you get the move in currencies as well as a US-based investor. So when the dollar declines, you get a tailwind of that other currency appreciating. And this slide here just shows the magnitude of the move that we've seen in the first 6 months of 2025. This is the dollar index, which is the price of the US dollar relative to a basket of other major currencies. And you can just see how severe that was, where first 6 months of the year, the S&P 500 up 6, Europe and Japanese stock markets up in the same zip code, but our total return was closer to 15 to 20%, depending upon the market, because of the currency move. So again, you've been hearing me preach international diversification in public equity for a while. It actually worked for the first 6 months of the year, which has been helpful. And that's what we want in a diversified portfolio, is owning a mix of assets such that something that we own is working in almost any market environment. And this is one where international equities help quite a bit. If we can go to slide 7. Thank you. We will be talking about private markets. This is a wordy slide, but it's slowed down. Private markets have slowed down, whether we're talking about fundraising, new investment activity, distributions, you name it. And nature abhors a vacuum. So private managers have been getting more creative in how they try to find liquidity. We're highlighting one of them on the slide here, which is what's become known as a continuation vehicle. So you can see how they have increased year over year in that light blue line. So if a private equity manager has 1 or 2 companies left, they'll offer liquidity to existing investors, but then try to raise new capital from new investors to continue to own that asset. I don't know if this is a good or a bad. I think this is just a new reality and something that we need to be aware of. When those happen within our current managers, if they raise, typically we take the money and run. Usually getting cash back is a good thing, but some of these are getting structured in a way that are more friendly to new investors. So it's something we're monitoring. Typically, it's a way for us to get liquidity, but just wanted to highlight this has been a challenge. Private markets have been fairly slow the last handful of years. We are very aware of this. And again, one more reason why we want to be disciplined on how we deploy new capital, because this can continue. We are starting to see some signs of life out of private markets, but we want to be disciplined if this dry spell continues going forward for longer than we would have expected. If we can go ahead to the next slide. This shows that public versus private divergence in trailing returns. So this is rolling 3-year returns using index level returns for all private equity versus the global stock market. I know it's hard to read that the light green line or gray line. Sorry, I'm colorblind, so I apologize if I confuse you. That's generally above. That's private equity, and it's typically been above private markets. You see it converge at the end of 2024. If we roll this forward to June 30, we don't have the June 30 private equity returns yet for the broad index. Public equity is up 17%. Private equity is going to be up 4 to 5%. So that illiquidity premium of the average private equity investment outperforming public markets has flipped. And the big question for folks looking over pools of capital like this is this just a cyclical trough and it's going to go back to the way it was, where private equity outperforms the majority of the time? Or is this a secular shift because too much money is coming to private equity and this is the new world order? And I think, like most things in life, our view is it's probably somewhere in the middle. More capital has come into private equity. I think it's going to be harder to generate those premium returns, and we need to be highly selective in the types of managers we invest in, the strategies we invest in, and a little bit of healthy skepticism and discipline, and not committing capital too quickly is what we're striving for. Again, a handful of the ones that met that threshold we are going to talk about today, but we are below our projection of what we should be committing. And I guess what I'm telling you is hopefully you don't view that as a bad thing, that we're not finding good ideas. We're just trying to have a really high bar and maintain some discipline. So if we can move to the next slide, we'll jump into the portfolio before we hit the recommendations. So we can go one more. Again, just reminder of where we're sitting. Everything in this presentation will be through May. So as of May, system-wide assets stood at 6.7 billion. And you can see the composition in the chart, 4.2 in the liquidity and capital reserve pool. And then the pooled endowment fund as of the end of May, a little over 2.5 billion. Markets were up in June, have been up again since then. So you can add another 2 to 3% to these numbers if you think about real time, where do we sit today? Because the portfolio has continued to grow since the end of May. If we can go one slide ahead, thank you. These are the trailing returns. We'll start with the pooled endowment fund. And a couple of things that I'll highlight. I think that we've been executing reasonably well. You can always get better. And again, you don't get everything right at investing, but you can see some pretty strong absolute returns, in particular on the 3 and 5 year numbers. And we're comparing it to that gray line of the pooled endowment fund benchmark, where we finally slice and dice and we have a hedge fund index, a private equity index, real estate, stocks and bonds, roughly in line with that. You can't actually buy that. Those aren't all investable indexes. So we're also comparing it in the black to a simple 60/40 stock bond, where you could buy that effectively free in an index. In line on the 3 year, 5 year, you still see a pretty wide gap. So despite this lull we've had in private markets, the bulk of that outperformance has come from private equity, a fair amount of which, not all by any stretch, has been realized because we have been building this portfolio for the better part of the last 10 or 12 years. If we can go to the next slide, this is the liquidity and capital reserve pool. Again, I think of this as more stay rich money. This is a more conservative allocation. Almost half the portfolio is in short-term fixed income, core fixed income, and cash. So you shouldn't expect high highs or low lows because it is, as the name implies, a liquidity and capital reserve pool. But with yields where they are in both cash and fixed income, you see some fairly nice returns. Year to date up 4%, 3 year at 7.1. So again, helping grow that corpus, but doing it in a very risk-aware way. We can keep moving and jump into the recommendations. So this is the summary. Hopefully I laid this out. Again, $68 million in aggregate. If all of these are approved, we'll be right around 130 million committed. Again, out of a endowment fund that's 2.6 billion and below what our modeling suggests we should commit, but in the right zip code and in a way that I think is disciplined. If we look at the managers listed here, the ones at the top in the private equity bucket, these are existing managers where we've committed to prior funds and they're coming back to market with their next fund. Within real assets, Rockland Power Partners will be a new relationship for the system, but it's a manager that we at FEG have known for a long time, with a manager that we think very highly of, and a strategy I think is pretty timely, which I'll lay out our thesis for why their opportunity set looks fairly robust today. So we can jump ahead. Again, just setting the context at the asset allocation level here. And what we've circled on the left-hand side is we're sitting at around 45% of the pool in publicly traded stocks. Long-term target is lower than that. And you can see we're underweight to private equity. Longer-term target in those kind of mid-20ish%, we're sitting around 18%. So point being, we do have some capital to commit. You're always on a bit of a treadmill within privates to commit because cash is coming back. We also are trying to, in a disciplined way, build up a more meaningful allocation over time. The next slide, I flew by the managers, but 2 of them really are focused primarily on technology as a sector, both Great Hill and then Menlo. And again, trying to show here, if you rolled up both our publicly traded stocks that we own and the private equity, what is the sector composition? With the point being, we want diversification, and hopefully that's what is coming through on the slide. So you can see that the biggest bar there is technology. It's a little over a quarter of all the businesses we own, both private as well as publicly traded. But technology is seemingly everywhere and a very large part of the economy. If you look at it, at what percentage is technology of all publicly listed stocks, it's at 27%. That's kind of random that we're exactly at that target, but we want to be somewhat similar in exposure here to have that diversification. You'll see some where we're a little higher, a little lower, but I guess the point being, we're not trying to load up on technology. It's just a big part of the opportunity set, a big part of the economy, and there happens to be two managers that we like coming back to market today. So we'll get into the pacing and the breakdown of private equity on the next slide before we get into the managers. So again, this is similar layout as you've seen in the past, and I'll walk through this clockwise quickly. Top right, if you look at private equity specifically, you can carve out the real assets. So 180 committed annually is our estimate of how much we need to commit, 130 million of which is private equity. And again, never going to hit it perfectly, but we want that vintage year diversification. Which year you buy a business, just given the cycles, matters a lot. We may have a view that one year's a little bit better or worse, and have a little more, a little less, but we think it's kind of arrogant to believe you know exactly which year you want to commit and have another year where say we're going to commit nothing. So again, we're going to have that discipline and then lean in and lean out a little bit at the margins. On the bottom right, this shows what style of manager. Is it buying earlier stage companies, more venture? Is it more buyout? And again, you see different colors each year where we're having diversification of the styles we're investing in, just like within publicly traded stocks. Value and growth go in and out of favor. Same thing happens in private markets, so we want to have some balance. And then if you roll it all up of what do we own, and then how much do we have of unfunded commitments, I think the pie chart summarizes that nicely by strategy, where you can see buyouts and then the secondaries, which is those two combined. Think of those as more value-oriented, buying existing businesses that generate a lot of free cash flow, where you can pay a fair price. You don't have to pay for future growth. It's a little over half. And then the growth equity and venture is more akin to growth investing in public markets, where you're trying to find those faster growing sectors and businesses where the market commands a little bit higher price, but if they grow at the rate they're at, if they're growing 20 or 30%, you can generate some great returns. That's a little bit under half. So again, in our minds, reasonable balance. You can never get it precisely because you can't buy and sell these every day, but factors into our thinking of how we're committing capital to try to keep a healthy balance there by strategy. All right, so we'll jump into Great Hill here on slide 18. So we have the summary at the top, the bottom, a lot of returns of their prior funds, and then you'll see the system logo next to the funds where the pooled endowment fund has committed previously. And this is a relationship dating back to 2008. That's been in the portfolio, predates us. You can see the funds we've in. It's been a good experience, very strong returns for funds 4 through fund 7. That fund 8's been a little bit softer. We'll hit that in a second. But why do we like Great Hill and what do they do? This is a firm out of Boston that's been doing more growth equity, so buying fast-growing businesses, tend to have some technology component to what they do. But this is not venture capital where it's two people in a garage with an idea. These are real businesses generating revenue, typically growing 20, 30, 40% a year. And they're reinvesting the vast majority of that capital to fuel existing growth versus trying to just purely maximize profit margins. Eventually, you got to make profit, and they're very focused on that. But they're comfortable reinvesting into the business if they have an opportunity set in front of them to grow a little bit quicker. And this is a firm that I would say has a very strong culture of holding people to a high bar and excellence, and they've largely achieved that. Fund 8 was during a little bit of the ebullience where some of these businesses got trading at pretty high valuations. They had a couple of companies that have got off to a slow start, hence the lower returns is the first point I would make. The second, they've been very slow to invest. So you can see that fund is a little over 40% fully drawn as of the date of these numbers, which I want to say is March. They've since made a few more investments and they're coming back to market now, but that drags out your return if you just start deploying capital slower. So this is not going to, Fund 8 will not be their best performer. And they've made a few changes at the firm to address this, both the types of companies they'll invest in. They've moved a few folks within the partnership that weren't necessarily carrying their weight. And our view is from Fund 4, 5, 6, and 7, they've earned the right to have one bad fund and maintain a relationship, but there's a bit more of a spotlight on them if you can't have two of those in a row. So they've earned the right. If this was a newer fund and it was a fund 2 or 3 and they had those returns, I don't think we would be on this Zoom talking about it. But this is a firm that's been around for a long time, executed at a very high standard, and one that we think is worthy of maintaining a relationship as they're coming back to market. So the recommendation here is to commit $20 million to Great Hill Equity Partners 9. So we're going to move to Menlo. So this is venture capital, and this is a firm in Palo Alto that has a very long history dating back to the 70s. The current leadership of the partnerships been in place for the last 4 or 5 fund cycles and have executed incredibly well. And again, in venture, this is the highest risk, highest return area that we will invest in. And you're looking for a couple of breakout companies to really drive performance. It's become commonplace to say power law is what you're looking for. You're having a couple of wonderful returns. You're going to invest in some companies that don't make it. But on balance, those big winners, you're going to make so much money that you can generate some pretty outsized returns. So we don't want the whole portfolio in venture by any stretch. But if you look at that pie chart, 6% or so of the endowment, plus or minus, in these types of areas where can move the needle if you have a handful of big winners. But this is the most selective area because there's nothing worse than a bad venture investment. They hang around forever and they don't make any money. Menlos has a pretty good track record and has built a bit of halo around them where entrepreneurs seek them out. And that's part of the game is you build this brand and halo effect where you just see deals and you get to meet the entrepreneurs earlier. So to give you a sense of some of their, excuse me, big winners historically, Uber would be one, Roku was another, and then more recently Stripe, which just IPO'd this year. So they've built a decent brand. Another one that hasn't IPO'd, but it's off to a good start in a more recent fund that we've invested in has been Anthropic within the AI space. And that's where a lot of the new startup companies are. Again, the revenue growth there is like, I don't even want to tell you the numbers. It's kind of ridiculous, but it also commands very high multiples. So they need to keep generating a lot of revenue. So again, this is one that we think meets that high bar, has built a bit of that brand and reputation for themselves. And then the nuance here, because there's 2 different commitments, you're seeing the flagship fund with a lot of X's and Y's in the Roman numerals, and then inflection. So the flagship fund, earlier stage, classic venture, seed, series A. The inflection fund is those follow-on rounds. So if they have a breakout winner and they want to keep investing, stay in the capital stack, but every step up as they have proof of concept and revenue grows, you have to pay in at a higher multiple for those businesses. So it's been de-risked is the good thing. The bad thing is your return potential is going to be a little bit lower because you're paying at a higher valuation. But if you can capture some of the growth, you can still generate some pretty good, pretty compelling returns. And excuse me, many of these, they are the earlier stage investor, so they know the company incredibly well. So they, in theory, have pretty good insights into those businesses, which ones they want to back on a follow-on round, and which ones they don't. So this is a pretty heavily oversubscribed, meaning they have more demand to invest in this fund than they have capacity. And they're at a point where they get to kind of choose their investors. And thankfully, we've had a seat at the table in prior funds, which gives us first dibs versus folks that weren't. And I think it makes sense to maintain the relationship here with Menlo, with 15 million in the flagship and then 10 million in the inflection, having a mix of both. But again, if you're investing in venture, you want the upside, so having more capital in the early stage fund versus the later stage fund. All right, I know I'm going through this quick, but hopefully this is painting the picture, and then happy to go into details on any questions. So we can hit the next recommendation here. This is going to rhyme with what I talked about with Menlo. It's just a slightly different flavor and 2 funds being raised off cycle. So an existing relationship within the endowment is Atlas Ventures, also in Boston, venture capital focused, but life sciences and biotechnology versus pure play tech. We are invested in both their early stage fund as well as their later stage fund, which they call Opportunity versus Inflection. And they raised the capital off cycle. So we committed to their most recent early stage fund. They're now raising their later stage follow-on fund. Similar story here, heavily oversubscribed. has built an incredible brand as one of the preferred partners to invest in early stage life science and biotechnology companies. We committed 8 million to the last fund. There's no additional room, so the recommendation of 8 million is because that's all we could get, and that's how much we committed in the last fund because there's not room to size up. I've built a great track record here as well, and have had pretty good success. It's an area that's been a little bit out of favor. Life sciences and biotech became the hot dot when COVID first hit, and some of the amazing science helped quell the global pandemic and COVID, and a lot of things got overfunded. It's been wandering in the desert for a bit the last 4 or 5 years, which the good news is there's just less dollars invested in the space, which gives folks like Atlas a better opportunity to find some of those breakout companies because there's not as many people competing. There's still competition, there always is. But on average, when there's fewer dollars chasing a finite number of good ideas, that's helpful. So again, the recommendation here, given their track record, pedigree, and the brand they've built, is to maintain the relationship at an $8 million level for Venture Opportunity Fund 3. All right, I'm going to round this out with the final recommendation in real assets. We'll again set the table here at the allocation and the strategy level before we dive into the recommendation. So here, a little bit smaller allocation to private real assets. Same pacing model suggests somewhere around $60 to $70 million a year. We've only committed 20 so far year to date. Nice diversification within real assets. There's a lot of different things you can own. So if you look at that pie chart on the bottom left, fairly even split between more natural resource related investments, real estate, and then infrastructure. We have a couple of renewable investments. I would put Rockland, what we're going to talk about more on that, infrastructure slice of the pie in what they do. So smallest slice in their specific strategy is a little different than some of the other things, the businesses that we own and assets that we own in this space. So who is Rockland and what do they do? We can go to slide 22. This is a firm that's been around for a little over 2 decades in Texas that buys power producers. So private independent power production that supports our grid and infrastructure. These aren't regulated utilities. These are independent power producers that sell that power into the grid. And this is all they've done in their prior lives. These folks were operators or investors in the space at other firms. They've built out the operating know-how and knowledge. There's a fair amount of nuance here. And the tailwind that's made this, I think, timely is just the amount of power and compute that AI, data centers, and everything that's going on is consuming. We have a bit of a bottleneck here to support that build out and growth. And these are folks that are really good at figuring out how to do that. And they tend to look for more fixer-uppers where there's a natural gas plant, whatever it is, it's not operating at an efficient manner. Come in, buy it right, buy it on the cheap, identify the problem, get it fixed up where it's producing at a higher level, and then sell that to the next owner that wants to own a stable or a more stable asset. Stabilized asset has the contracts in place, has a fair amount of free cash flow, but sell it at a higher price than what they bought it. So if you look at their track record at the bottom here, Fund 1, they did do more renewables, and they've learned their lesson and said that's not who we are. So that's really the one poor performing fund that they have had. If you look at the returns, you can attribute almost all of that to some of those investments that are no longer a part of the scale and scope of what they're doing today. And since then, on funds 2, 3, and 4, you're seeing first or second quartile returns, mid-teens to low 20 IRRs, and for the more mature funds, knocking on the door of getting 2 times their money or better. So again, that's the thesis. You have a unique sector where it takes some expertise. This is a group focused exclusively on it, and they have some macro tailwinds of just a bit of the bottleneck for the need for power that's hitting our country today that they're uniquely positioned to address. I guess the last piece that I didn't mention that I should is they're doing it out of a fund. They're targeting 800 million where there's not as much demand. There are some really large firms playing the space, but they need really big assets to deploy a lot of capital. Those tend to be a little bit more efficiently run, command more premium pricing. So they can buy things that are a little not as highly trafficked, but if they can fix them up where they're producing more meaningful power, they can turn it into that core asset. They're buying it more where it's a little bit more scratch and dent. It's got some hair on it, but they know how to fix it and they know what the problem is, and they think they have the expertise to course correct and turn it into more of that core asset that commands more premium pricing. So that is a lot, but hopefully that's helpful backdrop. Again, I think the conclusion here is performance has been strong. Markets have helped tremendously. We never want to confuse brilliance with a bear market or a bull market, I should say. But we're executing on the strategy. We're trying to be disciplined within private markets. It has been slow going, so we don't want to get over our skis, but we have not committed much capital. And with these recommendations, we're still a little bit below the pacing that we've modeled out. But again, a little bit of conservatism right now we feel is warranted, and we're trying to keep a really high bar on anything we do commit to in the private markets where we're locking up pooled endowment funds capital. So with that, I will pause and see what questions the committee has.
Thank you very much, Nolan. That was a lot of information, as is typical. And I don't even want to touch what's going to happen to private markets once retirement accounts get to access it, but we'll discuss that later. So are there any questions or comments from the committee at this point?
No, and I have one. This is Ron down in Tuscaloosa. I need a really quick answer, but I just noticed on the last slide, the Rockland focus on power generation US and UK. Are you concerned about the exposure in the UK given their volatile political situation?
No, because it's de minimis. You should consider this almost exclusively. It'll be a very rare exception they go outside of US jurisdiction.
Great, thank you.
Thank you, Ron. Any other questions or comments? Okay. Well, our agenda contains 5 items for consideration. Prior to opening the floor for discussion, may I have a motion to consider the items collectively?
Motion.
Second.
Thank you very much. Justin Fanning, Assistant Vice Chancellor for Investments and Treasury. Would you please present the items?
Yes, thank you, Trustee Gromberg. Nolan Bean with Fund Evaluation Group has presented a recommendation for the investment of funds with 4 existing managers and 1 new manager. The resolutions before you are as follows. For the pooled endowment fund only, in private equity, invest up to $20 million in Great Hill Equity Partners 9 LP, invest up to $15 million in Menlo Ventures 17 LP, invest up to $10 million in Menlo Inflection 4 LP, and invest up to $8 million in Atlas Venture Opportunity Fund 3 LP. In private real assets, invest up to $15 million in Rockland Power Partners 5 LP. Trustee Gromberg, I recommend approval.
All right, great. Thank you very much, Justin. Are there any questions or comments from the committee regarding these items? So we have a motion and a second. Since there is no further discussion, we'll take a vote. All in favor of approving the resolutions, please say aye.
Aye.
All opposed, please say no. The resolutions are approved. There being no further business to come before the committee, we stand adjourned. Thank you all for taking some time out today.
Thank you very much.
Thank you.